QQQM fell harder but bounced back faster, proving smaller losses don't always mean quicker recovery in growth funds. SPYG lost less, but took 100 days longer to recover. That's the paradox we're unpacking here today. Nearly identical performance here. QQQM's 23% barely edges SPYG's 22% over the past year. QQQM's pulling ahead with a 107% three-year return, beating SPYG's 99% by 8 percentage points solid. QQM edges out SPYG over 5 years, 103% versus 99%. Small gap, but consistency matters long-term. QQQM edged ahead over 5 years, but it's like two race cars with identical engines. The performance gap was razor thin, nearly neck and neck the entire way. QQQM edges out SPYG with better risk-adjusted returns, delivering more bang for your buck on volatility. QQQM edges ahead with better downside protection, that 1.6 Sortino, versus SPYG's 1.5 means fewer gut-wrenching drops. Think of risk-adjusted returns like a report card. QQQM and SPYG both earned solid grades, with QQQM scoring slightly higher in both tests. SPYG's rock-bottom 0.04% fee is nearly 4 times cheaper than QQQM's 0.15%. That gap adds up over time. That tiny 0.11% gap becomes over $100,000 in extra fees over 30 years. Small percentages compound into massive costs. Think of expense ratios as couch change. SPYG collects every penny while QQQM leaves cash behind. Over decades, those pennies compound into real wealth. Both funds are tech-heavy at 51% and 48%, so you're getting similar sector exposure either way. SPYG's 10% financial exposure gives you diversification that QQQM's 0.23% simply can't match here. SPYG spreads your pizza more evenly, giving financials a decent slice. QQQM, it's basically a tech-only pizza with everything else getting crumbs. SPYG is way more concentrated in mega caps at 68%, while QQQM spreads it out more at 49%. SPYG spreads your risk across 217 holdings, while QQQM concentrates everything into just 103 positions. That's half the diversification. QQQM's beating SPYG on returns with that 8-point lead, but you're paying nearly 4 times more in fees for nearly identical tech exposure. SPYG spreads your risk across twice as many companies, while QQQM's concentrated in just 103 holdings. Fewer baskets means bigger swings in both directions. SPYG's smaller drawdown means you'd lose slightly less during market crashes. 2% can matter when recovering from losses. QQQM bounced back faster despite falling harder. Proves recovery speed isn't just about how deep you fall. QQQM's mid-cap exposure drove its 100-day faster recovery, proof that mega-cap concentration can actually slow your rebound down. SPYG stumbles less but recovers slower, while QQQM crashes harder yet bounces back faster, like racing athletes with completely different recovery styles after hitting obstacles. QQQM crushes on performance but bleeds fees. SPYG saves costs but sacrifices 8 points of returns. Classic trade-off. QQQM's tech concentration wins in bull markets, but SPYG's diversification cuts losses when things turn south. QQQMs for growth chasers willing to ride volatility, SPYGs for folks wanting growth without the wild swings. Racing athletes know QQQM sprints for bigger wins, but crashes harder on turns, while SPYG maintains steady marathon pace with lower costs. Choose your racing strategy. The fine print's important. This is education, not investment advice, so do your homework. That's a wrap on this ETF battle. Hit subscribe to catch our next data-driven showdown every week.